Let's touch base with Nilesh Shetty, Associate Fund Manager at Quantum AMC, joins us on the show right now. Nilesh, good to have you on the show. What's the call on the market that you're making right now?
Broadly, we are sitting on a bit of cash this year. At the start of last year, we were on very low cash. There was very clear opportunity in interest rate cyclicals. At least that is where the incremental cash flowed that time. Right now, we are struggling to find opportunities. There might be some select opportunities in certain sectors which have underperformed. But broadly, given the upside that we've had in CY12, almost close to 30%, deploying cash has been a bit of a struggle for us. And I think we're hoping for a bit of correction for us to get the opportunities that we want. But the assumption is valuations are slightly above mean right now. And we'll have to wait for a while to get or to be able to deploy cash that we have.
The IIP figures surprised you, Nilesh, or do you believe that this is probably the Diwali effect coming into play? Because not just capital goods, everything else also contributed. Do you think this can sustain?
We've not looked at the IIP very seriously. Our economist who manages the debt fund, he's fairly pessimistic of the IIP number, saying that the index itself is quite suspect, and it tends to throw up random numbers. So at least, but the real data that we track in terms of cement production and steel production, that suggests a slowdown. So it's not that the industry is not slowing down, but looking at the IIP number itself is slightly misleading. At least that is what our economics team tells us.
There is strength in Nilesh. If you look at rate sensitives in general, yes, because real estate has bounced, as have some of the banking names, and we'll come to that as well. But just one word on the strongest performer, I believe, the last few sessions, and that is autos. Four-wheelers, two-wheelers, everything is doing well. If you had these stocks in your portfolio, would you look to maybe make switches out of auto into certain underperforming assets, or would you be comfortable holding on to auto?
But they are getting expensive, and some of them are getting closer to sell valuations. At the start of the year, there was a clear opportunity. Some of these stocks were available at almost 3% dividend yield. And at that time, the assumption was interest rates were going to rise. But the only thing that we were confident of was downside was very limited, given where valuations were. Now the valuations are very expensive, and the assumption is that the economy will expand and interest rates will come down. So now is not the time to at least buy these stocks, and you might get closer to exiting some of these stocks. I think those who have can ride out the interest rate expansion, but not necessarily adding or at least reducing some of the. Our sense is to reduce the holdings that we have, not necessarily adding to any of these names.
Where would you be underweight on tactically right now, Nilesh?
The clear underweight that we have in our portfolio right now is consumer staples, where our assumption right now is valuations are highly overextended. In some cases close to bubble valuations. So we have very little exposure to consumer staples right now.
Nilesh, what about how do you play banking right now? Because clearly the last few days there has been a bit of a flutter in the banking space with the hopes of, a banking amendment bill maybe giving rise to M&A activity, and a lot of market participants are latching on to some of these prime takeover candidates as well. That, or per se playing the undervaluation theme in PSU banks, is that something that you would look to maybe add on to your portfolio, or you would avoid that?
So the time to add these stocks to the portfolio was at the start of the year, where they were quoting at deep discounts of valuations, where the assumption was interest rates were going to rise and they would not do that well. Now again, the stocks are already factoring an interest rate down cycle, and so valuations are above mean right now. If you have, at least our sense is, if you have them in the portfolio, you can ride that wave. But again, they are not cheap now, so to add to the portfolio. And you can ride the interest rate down cycle, and a lot of them will get close to sell valuations perhaps a year down the line. But relative to that, we don't tend to play PSU versus private. It's purely a valuation call, irrespective of where the stock lies.
I know, which is why I was asking if indeed the mid-sized PSU banks offer value. But I'm just thinking from the answers that you've given me right now, as well as you saying that you're finding it increasingly difficult